The stock market is turning out great returns this year. Let's get some common sense from Craig Bolanos on the bond market. Craig is the CEO and founder of WMG. Craig, is it a good time for investors to give the bond market a closer look?
Well, Angela, this is absolutely an attractive time to start looking at and incorporating additional investment grade credits, bonds issued by companies. And I also want to mention too, on another note, that we might just be at an inflection point. It might just be the time to start extending duration. What do I mean by that? Extending the maturity of the bonds. That might be advantageous from a total return perspective. It's been a decade. In fact, it's a decade and a half since investors could obtain interest rates from bonds in a similar fashion as to that through which can be garnered today. So with starting bond yields being some of the best we've seen now in the past 15 years, I think all investors really ought to take a look and maybe give the nod to some credits, some investment grade corporate bonds as a part of some of their portfolio solutions.
I'm going to have you break it down a bit more. Tell us about the interest rate payouts coming from bonds.
Well, let's break down some of the different segments of the bond market to obtain a glimpse of the possibilities. First, I think about the treasury market, treasury bonds. Up and down that yield curve, investors can garner interest rates today in the 4 to 5% variety. And that's 4 to 5% interest backed by the full faith and credit of the United States of America. That definitively provides a safe money solution for those who are willing to buy treasuries and simply hold them to maturity. Number 2 on my list, investment grade corporates, what we've been talking about so far today. With yields in the corporate bond market 5.25 to 5.75 for the good stuff, aka bonds coming from great companies of America, that provides a great opportunity for those seeking stability and income by creating what I call bond ladders, or maybe investors in today's environment actually want to consider building bond ladders through target maturity bond funds, because those can deliver the precision of individual bonds, but through the advantages and efficacy of an ETF, an exchange traded fund wrapper. And don't forget to maybe look under the hood and consider the third category, what I call high yield bonds. Because for those who are willing to accept that bonds are not just for ballast, for those who can stomach some risk, the high yield bond category, well, it's delivering yields today in the 8.5 to 9% space. I mean, that's a very intriguing place to invest with 8.5 to 9% coupons. Now, I need to remind everybody that we're still not sure whether the glass is half full or half empty. Are we on the eve of what I call a soft landing, or could there be a recession of some varietal? And as a result of that, if you are going to consider investing a portion of your money in high yield bonds, I really recommend that people partner with an institution that has good research capacity, because you want to be very choosy. You want to be very particular when you're doing high yield bonds, because you don't want to be stuck with some level of default risk. So I'm Craig Bolanos, the CEO and founder of Wealth Management Group. We exist to help people get retired and stay retired. Should you want to learn more, you absolutely can. Go out to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.